All
Okay,
right,
there you
guys,
go.
just kind of bot mentality here today. We're going to go over how I choose my strikes and expiration for scalping. So let's get into the video.
Oh, I really appreciate that.
Yeah, you're welcome.
Um, and so pretty much, all right. So pretty much, here's what I'm thinking. So, just for this specific day, I'm gonna choose if the price is 245. I'm gonna scalp next week's expiration. You're gonna choose the strike that logically over that time period the stock can easily return to. That's how I do it. Now you can buy further out, and I'll show you the differences in the strikes and the percentage gains. But that's what I like to do. Because the issue is like the 250s are, were $9 a piece, which is pretty expensive. But you could have got the 260s or 265s and still made a good percentage return. It's just that these are just the ones I chose, right? And I'll show you the difference. But you see, I was in at 9.48 at $9. I bought 5, and then a minute later I was out at 9.40. And so all that was, let me do the. Do I have the 20-day? 1 minute. Okay. Let me move back to it. All that was right here was me getting in at 248. So I waited until we flushed the 250. You see this 250? I waited till we flushed the 250 because, let me draw a line. That's where all the stops were, and that's the panic level. That's when people's emotions come into it. And that's what I was telling her. Like, it makes sense. Don't get in on 250. You can, because you see that it bounced twice off of it. But I like when that volume surge comes in to get some into there, and then just sell the pop back up. So I got in at 240 or at 948. So it was on this wick into 248 right here. And then a minute later, we went from 248 and bounced all the way up to a high of 249.33. That's a very small margin, okay, to get in and get out. That's pretty difficult. You see, when it bounced off 250, it had a larger bounce because it was 2 whole points, 2.5 points. But I sell low down here to get in. And so I knew that based on how the options were moving, if I got that bounce towards a dollar bounce, it'd be easy to kind of get in them, get right back out on the retest of that 250. You can see we didn't even make it there. So as soon as I got in, I set my price target and it filled on the bounce back up. Now, it was super bearish. Because every single beta name just broke support. So that's why this bounce was small. Normally, it would be a little bit larger, right? I would expect something like this, where it comes down to 244 and then has a couple different, 4 or 5 minutes back up and bounces $3, right? That was more of what I would have expected it to do, but you can tell by looking at the quotes as they come over that no, this ain't gonna happen because everything broke. So pulled back, bought it, sold it, and then the second entry, and I'll show you how I'd actually go about doing it. The second entry was at 9.52, and that was only literally a couple seconds. Do you see that?
You wanted me to respond? I'm trying not to ruin your video.
Oh, no, dude. Don't matter. Yeah.
Okay. Good. I have myself muted. Yes, I see what you're talking about.
Oh, no. Yeah. No, we're just talking pretty much. I'm just recording it.
Okay.
In it, 9:52:33, out at 9:52:47. So that was literally just a 14-second trade. And you notice I adjusted down to the 247.50s instead of the 250s because we had dropped lower. And I wanted a more realistic strike for the time frame, okay?
Sure.
So I could have still got the 250s, but I dropped down. So this time I got in at 9.52. So we had this bounce, I got out, and then we rolled again. So if I liked it here, I definitely like it down here, right? Mm-hmm. So when we rolled down to 9.52, I waited until we pulled back and broke the 245 support, just like how I waited on 250. So once we broke 245 was when I was interested in it. Let me draw this line here. So that secondary line right there. As soon as I saw us snap that right here, I bought, okay? Same thing, but I adjusted down from buying the 250 strike down to the 247.50 strike because it makes sense that we would see that bounce right back, right? I didn't even have to wait because I literally got in here.
Fill on the way back up.
Yeah, and you see I missed this whole part. You see that over the next 5 minutes? I didn't get into that. I think my strikes went to I can pull it up, but they went to, I bought them at 920. They went to $10, right? So I bought 5 at 870, and I immediately said I'm going to sell at 50 cents, right, for $250 profit because I have 5 contracts. So 50 cents over 5 contracts, you're making 250, right? So I got in, immediately set a sell order 920. The reason why I chose 920 for the 50 cents 250 because I knew literally 1 minute earlier the contracts were trading for like 935, 940. So it makes sense that if we get that bounce back up to 920 or 940, they'll fill me on the way, and it'll happen so quick. So yeah, we got the flush at 245. I bought the contracts, and I'm on the limit, by the way. I don't market ever, so keep that in mind. I'm waiting for the price to hit my fill, and then I limit on the way out. I don't like market because if you market, like the bid might be at like let's say 870, but the ask might be at like 885. Or 890, and you don't want to get filled like that.
No.
So I set that limit, and literally the next candle, when we popped back over 246, as emotional as people were on the downside, they bought the calls, and I sold them right away. I didn't even wait. I didn't even get any of this right here. And so that's how I kind of look at some strike selection. I don't usually look at the 1 minute chart like when I'm trading. I look at the 5 minute. So normally I'm seeing this right here. I'm looking at this.
A little bit more time to develop, even though it's still a super short time frame.
Yeah, and you see how like I bought at the 248 and then sold this little bounce, and then it flushed again. So 2 huge 5 minute red candles on the downside, and then I sold barely off this bounce. But you see how much time you had on this bounce?
Yeah.
And then we rolled again, and then you see how much time you had right here to get out. That's what you're looking for. That's what the scalping is. You're looking for that 5 minute low, and you can buy the higher low if you want, but I'm looking to get filled in the limit, and then I immediately set the ask on the way out. So, let me close this. And so let me pull up the actual strikes. So here's TD Ameritrade, right? Yeah, because this is what you're using for paper trading. So, like on NVIDIA, okay? So for right now...
NVDA, right?
Yeah, NVDA, yeah. How I choose strikes, literally, is can the stock make the move in the time I'm giving it? Even if I'm scalping, let's say, for example, I was buying the 250 demand, and I buy at 250, and it goes to like, 245, right? Is it realistic that it can bounce, reclaim 250 and go to 255 by next week? It's like, yeah, I could do it today. And that's kind of how
basically, in the case that you do have to hold the stock or the contracts, you want to make sure that they can regain their position if you're forced to hold, essentially.
That's the safe way to do it, is to buy some time, because while your percent gains will be higher,
if you're, same day expiration.
Yeah, it's stressful, and I would rather just have the time. Like like Monkey, he bought on his straddle. He bought, I think, June's for this year. He could have literally bought like 2 weeks out if he wanted to, but it's so stressful doing that, and the probability of getting that move in the time is so much less. So like for example, NVIDIA, if like tomorrow, you can scalp these if they have like 4 days on them. That's fine. I wouldn't go out to the 12 days, but once you get 2 days into the week, I'd probably go to these, the March 4th. But what you're looking at is, see, the last closing price was 236.42. So when I look at these, we'll look at, if we're at 236 now, and I jump to look at the chart on the video just from today's session, you see we are, not today's, Friday session, sold off heavy after hours. So really we're at 232. So if it's at 232 now, and we came from 245 in a day, that's a huge drop. I'm looking at probably the 240s to buy. 240s or 235s with at least 5 days till expiration. Because if it can do, wait, what?
No, I was just saying. So you're looking at calls. So you're more bullish on this then.
Yeah, and I'm gonna. Okay. So in general, you look towards the opposite side when you see extension. So if the market is, and you know how on RSI, let me pull this up. For example, if you look at the 5 minute RSI, right? During the times down here we were most oversold, you got that bounce.
Yeah.
So I'm on the 5 minute right now. You see every time it touched 17, we went from 244. Yeah, 248. And then if you waited till 17 again at 10:30, you would have got it. And look, you would have literally nailed the bottom, right?
Interesting.
On that 5 minute.
So RSI is valid on shorter time frames as long as you're only trading that short time frame.
Yeah, you just have to be careful because in a significant downtrend, the RSI can stay oversold. Like I'm on the 1 minute now.
Yeah.
You see right here, it hit 30. And then it just went lower, and then it just went lower, and then it just went lower. You see what I'm saying? So zoom out a little bit. The larger the time frame, the better. Like if you go to the 15-minute RSI and you waited for a significant oversold signal, then it would have worked. You could have made some money on that.
But basically, you're saying don't like shrink it down to like 1 minute, or potentially just be careful with the 5 minute, because that's like it can extend oversold longer than just that like little blip into it. Basically.
Yeah, you can trend, and the same thing for overbought. You can trend overbought. Like see over here, I'm on the 4 hour right now on the video. You see how we literally stayed over 70 on the RSI for days. Okay, for like over a week. Yeah. So if you would have got short right here, you see this? If you would have got short right here because it's 70 RSI on the 4 hour, you would have got smoked swing trading.
Yeah.
So it can stay overbought and oversold during periods of strong trend much longer than you would want to hold it for.
Yeah. No, it definitely makes sense. That is one thing that I noticed, and I think Monkey, probably Agento, had both mentioned that too when charting with RSIs. It's not gospel. It's kind of the same thing with news. It's just something that you take into consideration, but that doesn't make your final decision.
Yeah, and the most valuable thing, let me tell you what you should be looking at. So RSI, definitely look at it. And the bigger the time frame, the more significant. But what's more significant than that is average range and basic demand and support. So if you know that in 1 hour, right? Let me find a good example of this. Let's see what a good example. If you know on the hourly, like for example, you see this day right here, the average candle range here is this candle in an hour moved $2.74. This one was $3. This one was $3. This one was $5, and this one was $4. Right? So out of these candles, a $3 move on this particular day, that's like average, right? So if you get like a $10 move, that's a significant range. Right? That's pretty huge. That's outside of the ordinary. And that's how you want to trade the levels. Just like on the daily, if you go to the daily chart, you have these days right here of average range of $13, $8, 4, 7, 6, 8, and 5, right? And then you get a huge day of 42-point range. Chances are you're going to see a pullback after such a huge move, right?
Gotcha. Okay. So basically, if you see a huge change in range, you typically will see a correction.
Yeah, you see a violent move
to the opposite direction.
Yeah, and that's what scalping is. You're looking for the extremes. You're not looking for the chop. So like this, you see this right here? You're not trading this. All this little stuff.
This stream's a little bit lagged. Hold on a second.
Okay. Yeah.
Yeah.
You're not going to trade.
Yeah, I'm looking at what you're looking
this little stuff. What you want to trade is the big volatility. When you see these huge range days, this is where scalpers can make their money because every candle has above average range. And I mean, like, if you compare like these candles, what is the range of this? 95 cents in 5 minutes, 50 cents, $1, 72 cents, 80 cents, 50 cents, $1.50. You see this little range? Now look at this day. The first 5 minute candle was a range of 7 points, $3, $2, 4 points. You see that? That's when I get excited. That's when I'm like, oh shoot, we have a high value day, because the more range there is, the easier it is to get in there and take your chunk.
Gotcha. And I guess that's probably one thing that is beneficial when you're watching pretty much just one chart, is that you can kind of get an idea for the range. So when you see something trading outside of normal range, you can immediately know, like, okay, this is opportunity for a scalp.
Exactly. Now I'm going to show you this. This is what I want to show you, the options, so you can kind of visualize why you pick certain strikes and expirations and the difference between them. Okay.
Okay.
So this is the day we're going to use. You see the video, you know, up, down, all this chop, right? We're going to look at the
catching up.
Oh, yeah. I'm going to be sitting here for a while. So what I'm going to do is I'm going to pull up the options charts on different strikes and show you the difference % gains on certain moves. Okay. So I'm going to zoom in here so we can see the full day. I'll get a little bit of the after hour for context. There we go. Okay. So I'm going to show this move here at 1:15, starting at 1:15 on Friday. Okay. The stock made a move from, let's just say, 230 to 242. Okay.
Okay.
230. That's a huge move, by the way. So that is a 5.22% gain on the stock. All right. I'm gonna put this. Let me get my notes up. I'm gonna take a note of this. All right. So the stock move was from 230 to 242 is a 5.22% gain. Okay. So if you bought the bottom here and sold the top, you would have made 5%. All right. So now let's go look at the options. So I'm going to go over here on the video, and how you can do this is on Thinkorswim. We'll just look at this week's expiration, right? At the time would have been like 8 days to expiration. We're going to look at the 240s. We're going to see how the 240 calls. So what you do is you right click that strike and hit copy, and then you can paste that actually in the name of the chart. So you'll paste that over here, okay? And it'll show you what the options did that day, okay? I'm gonna drop it down, go to the 5 minute, I'm gonna zoom in. Okay, the options, now I'll just stay zoomed out, be easier to see. So the options off that move from 1 p.m. all the way up into, basically 3 o'clock, went from a low of 489, yeah, 489, all the way up to a high of, what is this high?
Like 2 cents.
$9.
Yeah.
So from 438 to $9 is a 105.48% gain. Okay. So the 240s, you see what I'm saying?
Mm-hmm.
On the same move, made 105.48%. Okay.
So basically, you're saying if you had just bought stocks like outright, you would have made a 5% gain. Where if you bought the contracts, you make 105% gain.
Yeah. So the difference between the stock and the calls is a difference of 21x. So you would make 21 times more buying the 240 calls than you would buying the stock off the same move.
It's essentially trading with margin almost.
Oh yeah, super leveraged. Yeah. And so the question is, out of this 105%, do you think you could carve out like 20%, which is still 4 times what the stock made, right?
Yep.
So there's so much more available profit in that move in the options. You got to think about this. You would make 5% in like 5 seconds of this move. Like if your option went from if you went from 231.1 to 232 in like 1 minute, you'd be up more than 5% on your strike.
Yeah. Yep.
So now check this out. I'm going to show you this.
That's the thing, because like the slides I've been trading, they'll basically be like, give me a second. Go ahead, say what you're saying.
Yeah, sorry. I'm just going to show you this. So the 240 calls ended up making 21 times your money, or 21 times as a stock. I'm going to go over here, and a little trick you can do is instead of going back and like copy pasting another strike, you can actually go there. You see it has 2022 and then 5 and then calls 240s. You can just change those. Let's look at the 250s and let's see what the 250s did. Because I just said I would trade the 240s.
Oh, I see what you're talking about.
Yeah,
okay.
You can just do that.
240. Okay.
So the 240s went from a low of $2.18, or the 250s, $2.18 to a high of
like 430.
What is that? Let me zoom in. I can't see. A high of 440.
Yeah.
Okay. To a high of $4.40. Let's calculate that gain. So that's a 101.83% gain. Okay.
Yeah.
So the 250 calls went up 101.83%. Okay, now let's go look at the 260s, which, by the way, that is 101.83 divided by a difference of 5%. That's 20 times your money. Okay, for the 250 calls. All right, now let's go look at the 260s. Okay, this is just showing you can buy any strike. There's not like a. It's just you'll notice there's a risk. The risk reward tapers off, and you start making less when you get too far out. These went from 93 cents to a high.
177.
Yep, 177. Yep. So these went from 93 cents to 177. You're looking at a 90% gain. So you see how the gain's decreasing.
Yeah. So the further out you go, the less that you make because you're taking less risk, essentially.
Yeah. These are nice. Now let's go look at the 270 calls. And I'm showing you this because,
Which, by the way, it's still more than 5%.
Exactly. Exactly. You see where I'm going with this. Okay? Yep. We're going to look at the 270s. By the way, for the record,
honestly, 105 to 90% is not that big of a loss.
By the way, if so basically the people think by buying options you're going to hold till expiration and that's your bet. You don't have to bet that. You can buy the freaking 300s. There is no way in heck NVIDIA is going to go to 300 in 5 days. Okay? Yeah. But you can still make profit off of the move. This is what I don't like about S&P Capital's videos, because every video because he's writing biased. He likes to sell the option. So he's like, it's impossible, it's nearly impossible for the 20 strike calls to expire in the money next week. So the people that are buying these calls are essentially having a 95% chance of losing their money. No, because those same calls can go from 1 penny to $20 and back to zero by expiration. And as long as they sell on the way, they can make money.
Yep.
So these are the 270s went from 41 cents. What did we go up to? Dude, I can't even see where the high was.
70, 71, something like that.
71? Okay.
Yeah, is where we bounced up to. It's somewhere in there. It's freaking small. It's crazy.
I can't even see. So the 270 calls, these were up 73.17%. Now I'm just going to jump. Let's look at the 300 calls, okay? And then this is the last one we're going to do for this. So let's look at the 300 calls. 300 calls. Oh my gosh. Did they even change?
I think it pretty much stayed the same, honestly.
Oh.
We were at a low of $7 and we popped, or 7 cents. It was like 11 cents.
So it went from 7 cents low on the day to 11 cents. Mm-hmm. Which by the way is still a 57% gain.
Yeah.
Okay. So these had a 57.14% gain. Okay, now let me do something else. Let me go to the in the monies so you can see. So on this day on the video, let me zoom in. We're talking about this move from 230, 231 to 242. If you bought the 230s, let's see what the difference would be. Okay. So basically,
looking at a low of 938 to 1536.
Okay, so they went from 938 to 1536.
Yeah.
All right. So these were up 63%. So I'm gonna go here. The 930 in the money calls went up 63.75%. Okay, so what this is showing you is the in the monies made basically the same as the 300s. So if you're buying at the money or in the money calls, you're gonna make less. You're gonna make essentially the same amount as the freaking 300 calls, way the far heck out.
Yep.
Okay, the difference is the 300 calls are a heck of a lot cheaper. These are 7 cents a piece.
Yeah.
Yeah. These are 7 cents a piece. So you can buy as many as you want. It's easy to scale, okay? So you can buy 20 contracts, 30 contracts, 50 contracts, whatever, and scale them out, sell partials, whatever. But if you bought the 230s, you're spending $9 a contract if you got the low. Mm-hmm. So you're let's just say $10 a contract. So you have to buy one call for $1,000. Okay, that's how much equity you're gonna have to use to buy those $10. So you're using $1,000, and for here you're using 7 to make the same percent move. You see that? Mm-hmm. So I'm not saying buy the 300s every time. That's freaking stressful. I'm just saying, like, you have to be smart about strike selection because, especially starting off, chances are you have like between $1,000, $5,000 account, and so in a cash account, and you don't want to use all your equity in one trade. You see what I'm saying?
And potentially blow your account in one trade. Yeah.
Yeah. So it's best to, if I were you, and the stock prices, let's just say this one is at 231, you know for a fact it can be at 235 in like 10 minutes. Because it just dropped from 238 to 231 in, 20 minutes, right? 30 minutes. You know that it can go back just as fast, okay? In an hour or so. So if that's the case, and you know it can move, 10 points in an hour, right? Go ahead and go out for the at least 10 points. So if it's at 231, you don't need to be looking below the 240s, right?
Yeah.
You can get the 250s. You go 20 points out because the difference in the 240s, how much were the 250s?
Like 4%. Let's see here.
Oops, I messed that up. The 240 calls were $5, right?
250s at the low were like 2.
Yeah, and the 250s were 2. Get the freaking 250s, and at $2, you can get like 3 contracts for a $600 investment, right? If you got the 240s, if you got 3 contracts, you're putting in $1,500. So twice as much for the same percent move.
Yeah, essentially.
So here's a simple way to look at it, right? Let me pull up the video here. Basically, wherever the price is at, the blue boxes are in the money. The blue shading area is in the money. You need to basically go out, 4 strikes, right? So if you're at 230, go out 1, 2, 3, 4. You're at the 240s. Between 4 and you could say, let's just say 8 strikes. So here's 4, and you go down another 4. 1, 2, 3, 4, and now you're at the 250s. So your money zone is you want to get the 240, 245s, or 250s, and that's it. Because once you get out further than those 20 points out of the money, then that percent return drops. Sure, the options are cheaper, but it's going to be harder to make that cut because your window of opportunity is getting smaller. So that's kind of how strike selection goes. You want to go out of the money, 4 to 8 strikes. So 4 to 8 boxes out of the money, and look at that. If it can move $10 in an hour, like the average range is like $5 to $10 in an hour just based on the day, then you want to go out at least $10 on your strike, maybe even 20.
So looking at, hold on, let me get to the daily. So looking at something like Apple, where we're seeing the range is like $4, $3, somewhere in there. It's usually around like maybe like $5, $7.
Yeah.
So
you're looking at the daily.
We'd be, yeah, exactly. So looking at something like that, we'd be 1, 2, 3, 4. It's like 175. It's like 185. So like somewhere in there. And if you're looking at it right now, it's gonna be a little bit different, obviously, because we're not trading currently. But at 175, we're looking at 23 cents, and then at 185, we're looking at 2.
So here's what I would do for Apple. I'd bring up the daily, right? So like let's look at the past like couple days here. We had a range of $1, $3 or $4, $5, $3, $3, $3. Yeah.
Like the next one's like $5. We had a day of like 7.
Yeah. So you're basically, if you can get a strike that's like $5 to $7, like, or $5 to $10 out of the money, I would probably aim around 5, just because each day is normally 3. So for example,
just make it even.
Yeah, if Apple's at 170, you can get the 175s, right?
Yeah.
If you're getting at least, like 5 to 8 days to expiration, that's pretty good. Apple's, it had huge range. And the strikes are a little bit different. So if you look on Apple, like the strikes are $2.50 apart. So yeah, go out $5, and that's a pretty good amount. You can go closer on Apple, and the reason why I say that is because the options are so cheap. You can still get a couple contracts, and you're not like, And one thing you have to think about too is you're gonna pay more in commissions getting like 10 of the like if you go out like the 175s, if you get 10 of those, you're going to end up paying a couple bucks in commissions, versus if you just get like the 170s, it'll be like half the commissions or less than half. And another general rule here, you can use this as well, is when you're looking at Apple, you see the one, you look on my screen, you see I have the 170s, they're like a buck, you know, let's just say a buck 30, yeah, or whatever. You know that if this 170s go in the money, they're going to be worth roughly what the in the money strike is. Yeah. So these are the 165, so they're in the money by, as of the close, $2, right? So let's just say if we go from 167 to 172, you know the 170s are going to be worth like $4.
Yep. So it goes, it's like the $3 added onto your
yeah, basically.
price.
Yeah. And so you know at a glance, like, okay, you know, if we go in the money, I'm going to probably price mine at like, you know, $3.50, right? Have an order at $3.50. Or if we bounce $2.50 from here, from where the current price is, I know the 170s are going to be worth, you know, $2.50, because that's kind of the midpoint between here, because that's $2.50 close to the money. So if you buy now expecting the stock to bounce $2.50, your limit sell needs to be right around $2.40 or $2.50 to get hit, right?
Yeah.
But that's talking about today. If it doesn't do it today, you're going to have to continually adjust that limit lower, because you're going to be losing time value. But let me see. Let me pull
You're
up.
saying Yeah, no, I never mind. I answered my own question.
Yeah. So you're expecting, if you get a bounce of $2.50, you're expecting your 170s to be worth what the 167.50s are, basically right now, because they're $2.50 closer to being in the money.
Yeah.
And that's
that definitely makes sense.
Yeah.
I think scalping will probably be a better setup intermediate, or like right now, because what's happening is I'm because I can get in like early at the market. If I like it, good. If not, then I don't touch it, and then I can just go work and just kind of keep an eye on it throughout the day. But I've been having trouble keeping an eye on it and being able to like readjust and stuff, which is where I did lose some money previously. Like the other day, you called me, you're like, "Hey man, what's going on?" I was like, "Dude, I haven't even been able to check the market. I had a trade on, and I really needed to adjust it, but I don't even remember what I was doing. I think I was like building that fence or something."
yeah.
Yeah, so I think that'll be better, just because then I can kind of trade for like 30 minutes and then leave it alone.
Yeah, exactly. And you with scalping, keep in mind, like, you need to make decent money. You got to get over commissions, and so for right now, I would practice with like one contract lots. That's the best way to do it. And be like, look, if you can buy, you know, you can see today this range on Apple, right, on the 170s. From 150 to 180 is just like $30, right? It's going to be kind of hard for that to be worth something. So if you have 2 contracts, you can make $60, or 3 contracts, you can make 90, right? But start with one, and just, you know, if you get a $20 or $30 profit, just take it, right? Or set a stop, break even, and just let it ride. And you know, if it comes back down, worst, you're going to get out flat. Just pay commissions, or you have a chance this thing might run back to where it was at the open, you know, $2 plus, and you make 3 figures on it, right? But you know, the worst you're going to lose is, let's say if you have a $50 stop, or you just RTZ it, is the price of the contract, which is nice. And that's what you want to practice. And then over time, you can start layering them on. But when you get these huge days like this, let me show you. So like on Apple, okay, so you see, you know, let's say today's Friday, right? It's not, but 2 sessions ago, we were at 172, right? Mm-hmm. So right now, dude, 2 days ago, these contracts that are a buck right now, these things were like over $4 up here at 173. They were $3.50 2 days ago. So if whatever, let's say there's no war in Ukraine, whatever, when we gap up to like 169, these $1 are going to be up here at like $2.50, $3. So you're making $100 there. This is the best time for these types of trades. Even if you go out, let me go out a little bit. If you go out a month, this is the 26 days till expiration, right? The 175s are $2. That's just $200, a $200 investment. Let's look at what they're doing. Okay, they're $1.88 now. On Friday, they were worth $2.30. So right there, that's a $50 win, right? If you got them at 188. But if you look, you have 26 days for Apple to bounce, right? If it bounces back up to 170, you're gonna make over $100.
Where are you getting 26 days from? Is that the expiration that you chose?
Yeah, I went back and I chose the 26 days till expiration 170 calls. So the March 18th calls.
Okay, gotcha.
Yeah, dude, 3 days ago they were $4. So you could buy one of them for $180. The most you can lose is $180. If Apple gets a bounce back to 170, you know you're gonna be up like, three figures.
Making like $3, yeah.
Yeah, that's what I'm saying. So you can get time on these contracts, and you have more time to be right with a defined risk, and that's kind of how you want to do it. When you get periods of increased volatility like this, you see here on Apple, you see how we had these huge down days where it was just speeding up and we were just getting killed, right? Those are times when you see this daily RSI come down here near 30.
Yep.
That's the lower risk option. That's when you can buy, if you want to.
You're saying buy calls there when you're seeing it at the around the 30, and then set a stop loss at break even, and then
once you're up, yeah. Once you're up, you can set it break even, or you can just say screw it. Here's how I do it. If I'm in a call, like I don't let it go. Like if I get in profit a decent amount, I don't ever let it go negative. I try not to. So there were some calls. Okay, for example, Amazon. Let me tell you a trade real quick. On Amazon, I'm gonna go ahead and I'm gonna stop the stream, or not the stream. I'm gonna stop.